Can science beat the strong S&P 500? Today we are going to analyze whether biotechnology investment funds can outperform the S&P 500. To do this, I have reviewed the data on Morningstar, updated it, and ranked the funds based on their performance over the past 3 years. We'll analyze their portfolios and cover the companies they hold, and finally explore the small cap companies that some of these biotech funds invest in. Could there be a potential upside in them? Stay until the end because the taxi is taking off. Welcome to Taxi Biotech, a show where we explore news and updates from the world of biotechnology and learn about its impact on the stock market. The stock data presented here reflects the performance of companies under clinical trials, but does not constitute any investment recommendation. This is purely for entertainment. I share part of this analysis on Twitter, where it is mentioned that the 3-year annualized return of the S&P 500 is 12%. In the image, we can see the results of the funds and ETFs. Only one fund, Janus Henderson, has outperformed the S&P 500, achieving a 17% annualized return over the past 3 years. Polar Capital comes very close, while the rest, despite being mostly positive, have underperformed the benchmark index. Some of these ETFs focus on small cap companies, which we will examine later. What does the best biotech ETF hold in its portfolio? Take a look. Its top 10 holdings, which make up more than 40% of the fund, are listed here. As expected, they consist of large, stable companies with strong products and upward trend. Biotech, Argenx, Amgen, Sarepta. As always, I leave all the links in the comment below, so you can check the source yourself. Comparing these fund holdings to last year, we see that most of the companies remain the same, with no significant percentage changes. These funds are so highly regulated and cannot allocate too much in a single company. All of them diversify their portfolios, so for small investors like us, holding 80 companies in our portfolio is not feasible. So we either buy an ETF or fund or invest in specific stocks. What can we do with all this information? First, if we want to invest in biotech funds, we know now which one to choose. But watch out for fees and minimum investment requirements. Second, we can look at their holdings and pick the stock we like most to try to achieve similar returns. Another takeaway is that there are better options than XBI or IBB. In the end, this index simply includes all Nasdaq biotech companies, and as I've mentioned several times, some of these companies compete directly with each other. So when a drug gets approved and there is competition between multiple companies, one stock might surge, but the others will drop. This can lead to a neutral or even negative overall performance of this index. And the third one, and this is purely my personal opinion. Look, we are scientists and we understand the science behind these companies better than the average investor. That gives us an edge. Okay, there might be gardeners investing in car manufacturers, but as we say in Spain, stick to what you know. We believe we can have a competitive advantage if we focus on small cap companies where large funds cannot invest. That's our small niche to exploit. If only one fund has beaten the S&P 500 in the last 3 years, then why take the risk? I could rather just buy the S&P 500 and leave biotech to us, small investors. And that's precisely the same strategy followed by small cap funds, the ones riding in the small taxi, moving small capital. So, which companies have they selected? Let's take a look. These funds moves around $3 million, $20 million, €2 million, or $18 million. So these companies are among their top holdings. Now it's time to analyze them one by one to see which are interesting. They aren't exactly microcaps. We are talking about billions of dollars in market capitalization and hundreds of thousands in daily trading volume. Among all of them, I selected just 2 to show you how I filter stocks. You already know that I like companies with short to mid-term catalysis, as they can provide a strong price appreciation. So I selected as an example Ascendis and Axome Therapeutics. In Axome Therapeutics, since I made a dedicated video about it last December, it has seen a peak increase of 70%. not bad at all. What's interesting about Axome is that its pipeline is at a good stage, with major catalysis coming this year. Looking at one of its latest press releases, the company reports year-over-year growth. The drugs are growing, so we expect sustained revenue growth this year. Plus, it recently had another drug approved, meaning more revenue coming in. They plan to submit 2 more drugs applications to the FDA in Q3 2025. They expect a phase 3 trial results for a new drug in Q1 2025. That's what I've marked in red, because I'm not sure whether the data will be good or not. Since this phase 3 result is coming soon, Q1, I personally wait to see the outcome. If the data is bad and the stock drops significantly, we still know the company has growing revenues and upcoming FDA filings. About the FDA filings, I might not hold through the final FDA approval decision or not, as there are uncertainties around here. For example, their Parkinson drug had one successful phase 3 trial, but another didn't go well. That said, the company already had a pre-meeting with the FDA, and the regulators agreed to review their approval application. Once they file the application, it will take 30 to 60 days for the PDUFA date to be set. That's when we should pay attention and consider an exit strategy. Of course, none of this is investment advice. We are just here to understand how this market works for entertainment purposes. And next company of the list, Ascendis. Ascendis is a company that launched its product within the past 2 years, meaning it's still in a growing phase. While it doesn't cover its expenses yet, it has enough cash on hand to stay solvent for at least another year. That means that we don't need to worry about the stock dilution for now. What I like about Ascendis is that it has a major catalysis coming this summer, an indication expansion for adults for this best-selling drug. We already know this drug works well and is safe in children, so getting FDA approval for adults should be relatively easy. Meanwhile, its other drug is expanding across Europe, and they were also planning to submit another drug application to the FDA. And when they release this phase 2 trial data, the stock movement was positive, 16% upside. This is a good sign for the scientific data. So as a conclusion, what strategy should we follow? Okay, now you've seen my take on biotech funds. You have the best performing funds ranking and my approach to select small cap, medium cap stocks with near-term catalysis. So what do you think? What would you choose? These are just 2 examples. Analyze all of them and share your thoughts in the comments below. See you in the next one.